That the majority of my stress, at least when it comes to my portfolio, is coming from my stock portfolio rather than my real estate holdings. So I've been doing a little bit of thinking, especially as we're going through some pretty volatile times in the markets overall. Obviously, with geopolitics, there are some huge issues and all sorts of instability and potential risk factors in investing. But anyways, I'm looking at my own portfolio right now, and I've had a few holdings, at least in my stock portfolio, that have gone through some pretty rough times, especially following some earnings calls that really weren't all bad in themselves, but investors certainly didn't seem to like them. So my stock portfolio has taken a pretty substantial hit, especially over the past few months. And that's just on the stock side. But I've been thinking more about my portfolio allocation and this whole idea of return on brain damage, which is something that I think was coined by Bill Ackman. He's a billionaire investor who has his fair share of controversies, of course.
Hell is coming. Okay.
But he's talked about this idea of that you need your return on investment to outweigh your brain damage that you'd suffer in holding that investment, or I guess another way to put it is the stress you would go through by holding this investment. And it's an interesting concept that is really difficult to quantify, especially if you haven't actually gone through a particular situation with your portfolio. You haven't gone through significant volatility. You haven't gone through some event that makes it very difficult to maybe pay down some debt that you have to pay or something like that. It's really hard to figure out how to weigh that sort of event because it's not something that is objectively quantifiable. But there are important considerations nonetheless. With stocks in particular, at least something that I'm really starting to notice, is it is very hard not to pay attention to what's going on with a stock's price because it's throwing it in your face all the time. It is saying, hey, I'm worth this. You can pay this right now to get this stock. Oh, now look what's happening to your portfolio. And if you pay attention to it at all, and sometimes it's very hard not to, whether it's human temptation or simply because you're getting alerts and it's being thrown in front of you, there are lots of things that are pointing you back towards your stock portfolio or whatever stock holding it is. You constantly are reminded of the price of a particular stock, which can get quite annoying if you're trying to hold for the long term. And one thing I've started to notice with my own portfolio is most of my attention and stress is going towards my stock portfolio, which right now is worth around, we'll call it 100. Well, I guess if you include my retirement accounts, it's more like $150,000 or so. But compare this to my real estate portfolio, which is something like $600,000 or so. I'm not really sure the exact number, but it's something like that. And then there's a few $100,000 of mortgage debt mixed in there. So really the vast majority of the risk in my portfolio is concentrated in real estate, and specifically a few real estate deals. It's not like we're talking about thousands of properties that could diversify some of that risk away. Yet in your average week, I spend almost no time thinking about my real estate deals, just checking in for maybe a few minutes per week. Maybe my manager says something about something on a particular property that I just need to make a yes or no decision on, or maybe I'm just moving some cash from a reserve account into another account or something like that. But I really don't spend a lot of time stressing about my real estate deals. Now compare this to my stock portfolio, which has, like I said, gone through some rough times recently. And it's very, very difficult to try and pull my attention away from what's happening to my current returns and instead focusing on the long term. And really the principles are very similar to real estate. I'm investing in both real estate and stocks for the long term. I don't plan on selling anytime soon. I'm buying into deals because I think they're good for my own risk tolerance and my own preferences. So I want to hold these things for the long term. Yet for some reason, maybe it's because of stock alerts and stock prices being thrown in your face all the time, which, I mean, really the price actions of real estate can be quite similar to stocks in any event. There's so much debt in the system. There's plenty of risks with real estate. Sometimes one is inherently less risky than the other. But the fact remains that the majority of my stress, at least when it comes to my portfolio, is coming from my stock portfolio rather than my real estate holdings, which make up a larger share. And part of me wonders if this is some sort of competence thing. Since I've only been investing for a couple of years, I really haven't seen a whole lot in the grand scheme of things. And my portfolio is relatively small also in the grand scheme of things. Sure, it's significant since I'm putting a lot of my money into it, and I'm going to continue doing that for the foreseeable future. But still, again, it's only been a couple of years. I've only seen so much, and I've only really been studying the game for so long. And if we break down those years that I really have been investing and putting a large chunk of my income towards investing, which has really been since about 2018, even within that period, I've spent more of that time looking at real estate and understanding the real estate game than stocks. Stocks has really been in the last couple of years that I've really tried to learn a lot more about, or I've really tried to learn more about what some of the great investors do and their methods for doing things. And it definitely helped that I had this real estate background, and it's allowed me, at least I think, to really get up to speed with a lot of different stock concepts, since a lot of the same principles are very similar. And another added wrinkle here that I'm always trying to be conscious of is my YouTube channel. And sometimes those decisions might not pan out. And then I have to answer to all of you, for those of you who might be wondering, hey, remember that decision you made? What do you think about that now? What lesson did you learn? Or maybe you just want to make fun of me. And I'm constantly reminded that way as well, which is both good and bad. It's good in that it forces me to sort of reckon with the problems that I might have had before, or the poor decision I might have made for whatever reason. I'm not saying I've actually done that to this point. We'll see, time will tell, but as time moves on, I'm sure I will have more and more mistakes really show themselves. I've made mistakes in my investing journey. I'm not saying I'm perfect. For example, the basement flood a while back, that was a definitely preventable mistake with my house, in that I didn't get a sewer scope done. And now I know to always do that if I'm going to actually be going through with buying a property. Even if it is one that doesn't seem like it would have that problem, it's worth paying the few $100s to avoid potentially $10,000 in damage like I had to go through just a few months ago. But I guess you could say YouTube keeps me accountable, but that in itself is stressful and can be quite exhausting. So it's part of that return on brain damage sort of equation, in that, sure, I might be learning more, but at the same time, it's very exhausting. And I have to make sure that what I'm learning is actually worth all that stress, which so far I definitely think it is. And I don't really see that changing anytime soon. But again, it's all part of this sort of balancing act. Like I mentioned, my real estate portfolio is significantly bigger than my stock portfolio, yet my stock portfolio takes up a lot more of my current stress allowance, if you will. And that is a bit troubling because it's a smaller portion of my overall net worth. Therefore, I wouldn't want it to take up more of the stress because, well, it's less impactful, I suppose, compared to the larger portions of my portfolio, at least one would think long term. And we can break this down even further. It's not as though I'm invested in just one single stock in my stock portfolio. I have a number of stocks in there, and some stock holdings are only a few $1,000s and some are many thousands of dollars. And the amount of stress or brain damage per holding is not exactly proportional to the actual size of the holding. That is, it seems like just the fact of having a stock in the portfolio at pretty much any amount is going to have some sort of base level of stress, even if it's only a few dollars. But granted, I probably wouldn't have a few dollars in a holding, but talk about maybe a couple $1,000s. That couple $1,000 holding might feel very similar to the $10,000 or $15,000 holding, since it's one of the few holdings that I have to pay attention to, I guess. And this could definitely be an argument for a more concentrated portfolio, which is something I've been moving towards. I used to have a very, very diversified stock portfolio. Not that I don't have plenty of diversified holdings, especially my retirement accounts. Those are all pretty much broad indices. But in my taxable account, it's mostly concentrated single company holdings. And when you have many individual stocks in your portfolio that are just individual companies, again, you're paying attention to all those. You can have stress from each individual holding. But as you concentrate down, theoretically, your conviction in each holding would be greater. So therefore, that conviction might outweigh any potential stress. So in that event, you might actually be less likely to be swayed by a short-term, otherwise stressful event because your conviction in that holding is theoretically higher. But in any event, I'm giving more thought towards this whole return on brain damage idea, especially while my portfolio isn't really all that big in the grand scheme of things. I want it to be much bigger than this long term, and that's probably going to be a result of me making more income, not so much in me producing a bunch of returns in the next few years. It's going to be me adding more money into the portfolio, in which case the actual return and the stressors that come from trying to produce those returns, it'll be a much different equation, let's say, because the portfolio itself will be a lot bigger. So the return I would get relative to the stress and brain damage would be a lot bigger. But right now, because the portfolio is smaller, the returns are also smaller, yet it doesn't seem like it's a proportional decrease in the amount of stress that I'm feeling, even though I know that this portfolio really isn't even close to where I want it to be years from now once I add a bunch of more money into the portfolio. But I do believe it's worth thinking about, because any mental energy that you spend towards some portion of your portfolio, or really towards any portion of your life, is energy that you then can't spend towards other areas of your portfolio or your greater life. I guess you could call it opportunity cost of the mind. So anyways, thought I'd share that. And if you have any hot takes on this particular issue, then definitely let me know in the comments below and we can get a discussion going. Otherwise, like, subscribe, all that great stuff. And until next time, take care.